Bo Fisher, Fisher and Weens Wealth Management. Well, this is the third video I'm going to have already sent out this year in 3 months. We're in unprecedented times. It is, to say the least, chaotic out there right now, both just living here in the Bay Area, let alone what's happening in the markets. So I wanted to touch on a couple different things. And as I was trying to figure out what to say in this video, I was dealing with potentially talking about different outbreaks that have happened in our world's history. I thought about maybe talking about other drops in the market and what happened and how they recovered. But really what I've decided to talk about today is math. Math is kind of universal. It is kind of black and white. And I'm going to use math to talk a little bit about investing and how we manage through these scary times. And so first thing I want to talk about and let you guys know is, as you can see, I'm here in the office. The Bay Area has, this is the first day, it's March 17th, and it's the first day of what is being called shelter in place. Now, shelter in place means the whole Bay Area for non-essential businesses need to all be closed. We believe we're an essential business to you, to all my clients. If you need money, we need to be here. So we're working, or at least I'm working. Our staff is being careful, but we're here to serve you and help you. So just know that you can call, you can email, and we're going to do our best to get back to you as soon as we can. Obviously, the markets are volatile, and I need to be working, so I am. But let's talk about the markets themselves. I'm going to show you a bunch of charts throughout this video. You're going to have to hang in there. But just listen as I explain each one of these charts and why it's important to understand the math that I'm going to be talking about. So first of all, I'm going to show you what it looked like in the last month in the stock market. That's what I'm showing you here. So this is the S&P 500 and the Dow Jones over the last month. And as you know, through just the media, the stock market has really dropped, and it's dropped very quickly. So in the last month, we are talking about a 26, 27%, almost 30% drop, depending on the day. What I'm showing you now is the last year in the stock market. And you can see how quickly the drop came. And we've always talked about how fast markets can move, both up and down. And this is a great chart that shows how quickly we've lost a significant amount of value in the stock market. But this next chart that I'm going to show you is conservative investing. And so I've added that. And conservative investing, just like my last video, really helps us stay a little bit more calm because we have investing that is not as volatile as the stock market. Now, I'm going to explain why that conservative investing is so important in these down markets when we're withdrawing money. And this is where we're going to start bringing in our math. So what I'm going to talk about now is, we all know about buy and hold. So if you can hold on to an investment even after a drop long enough, as long as it's a good investment, it's going to come back and recover and then hopefully make money in the future. We've all seen it happen throughout history in the stock market. So what I'm going to show you here, this chart, is let's pretend an investment goes down 50% in 1 year. We start with a $100,000 balance. After 1 year, you have $50,000. And then it starts to recover. And it takes 3 whole years to recover. It returned 26%, then another 26, and another 26. And finally, after the 4th year, you have your $100,000 back. That's great if you're able to hold on to it for a long period of time, 4 years in this case. But what happens if you're drawing money out? This is where it becomes very problematic with the volatility and when markets are down. This next chart is that exact same volatility, down 50% and then up 26% for the next 3 years. But in this scenario, somebody is drawing $10,000 out of their account each and every year. Well, here's the problem. Because you're taking money out at the low points, you're taking a significant percentage out and you're not allowing your account to recover. And so for the $40,000 that this person drew out over 4 years, it really, quote, cost them $60,000 in not being able to recover. Very, very damaging. So how do we deal with that? Well, that's where we start bringing in conservative investing. We can bring in bonds, cash, other conservative investments to help us manage through these volatile times. So what I'm showing you here is what happens if we bring in a 50% portfolio of stocks and 50% of portfolio of what I would classify as conservative investing. We're going to classify these just for without a better term, is just bonds. So 50% stocks, 50% bonds. And you can see here that in that exact same scenario, 50% down and then a 26% up for 3 years. When you compare the bond portfolio to just a straight stock portfolio, the bond portfolio actually performs better. Now, why? Well, because if your bond portfolio just returns 4% per year, let's say, every year it's getting a 4% positive return, whereas the stocks go down and then they finally recover. But during that down, the bonds were making money. That's good. Well, how does that affect our performance when we're taking money out? Take a look at this. This chart is showing you the difference between this pure stock portfolio and a 50-50 blend, stocks and bonds. And as you can see, the red, that's our stock portfolio, was down $60,000 after somebody had taken only $40,000 out over 4 years in a down market. But having bonds, we almost have $60,000, which is pretty close to when you start with $100,000, you take $40,000 out over 4 years and you have $60,000 left. It's basically like you got a 0% rate of return, which is really what the stock market did. If you remember, if we buy and hold, that's pretty good. But there's even better things we can do with these bonds. And this is where our important understanding of math comes in. What if in that portfolio of 50-50 stocks to bonds, instead of selling some stocks and some bonds to create that income, what if I only sell bonds? Because they haven't lost money in this scenario. The stocks have. Because we want to hold our stocks and let them rebound. So if we only sell our bonds during that time frame to create the income, this is what it looks like. And as you can see here, we almost have $70,000 after taking out $40,000 from a $100,000 portfolio over 4 years. Significantly different. Here are the 3 charts together where we have pure stock, that's the red, a 50-50 blend where we just sell some bonds and some stocks to create that income, that's that orange. But then if we only sell our conservative investments to create the income and allow our stocks and hold on to those stocks while the rebounding has happened, you can see how much more money we have long term. And so how do we deal with these downturns in these markets? They are scary. And we've had a significant one in the last month. But the way I'm doing it and the way we need to be discussing is when you have money coming out of your account, it's very hard for your account to rebound if we sell our investments that have lost money. But if we strategically only sell things that have done pretty well in this environment, which in our terms have been bonds and cash, if you're taking out income, I need to be strategically only selling and sending you money from those investments that have done well to allow the stocks to rebound. And that's what I'm doing. And you can see that we can use math to help us sift through and actually manage through these tough times. That's what I'm doing for you. Hopefully this is understandable. Hopefully I have explained why we can be really strategic on what we're doing for you when you're taking money out of your account. These are scary times. They just are. There's no way we can even say that they aren't, because they're scary for your health as we're dealing with a virus that we're not used to, and it's never been, we don't know how to deal with it right now. Like I said, right now we are shelter in place right here in the Bay Area. But we're going to get through this. And it's not only scary because of our health, but we have some fear out there on the markets. So there is a lot of uncertainty out there. But the way I view it is that we are going to be able to get through this together. This is unprecedented and it feels very different. But the way I'm saying it, it's always different when these markets go down, but it's always the same. The reason that these markets go down is different every time. But it's always the same because we learn, we adapt, and we come out the other side just fine. And I know that's what's going to happen this time. So I'm here, my staff is here to help, to calm the nerves if you have them, just to have a discussion about what's going on, and know that we're absolutely working our hardest to figure out what to do in these markets. So please give me a call, send me an email, let me know how you're doing, let me know if you want to chat. We're here to help. Until we're able to talk, until I'm able to see you again, be safe.